Good evening to those of you in the United States and good morning to those of you in Asia. Thanks for participating. My name is He Zhiguo, and I am the Fuji Bank and Head of Professor of Finance at the Chicago booth and the Director of BFI-China. Thank you for joining the Becker-Friedman Institute in China and Peking University today on our ongoing joint seminar series, Critical Conversations with Economists. Each month, we convene renowned economists from each institution for a critical discussion addressing economic issues facing China and the world today. It's my pleasure to welcome today's speaker, Lars Peter Hansen, for a dynamic discussion on how climate change uncertainty should impact the social valuation and policy. Professor Hansen will be joined by Professor Pengfei Han, who will moderate the roundtable portion of the program. We look forward to a great conversation. Following the discussion, we will open up to audience Q&A. At any time, you can submit the questions using the Q&A box at the bottom of your screen. Please identify yourself by the name and affiliation. Okay. So let me begin by introducing our moderator for today, Dr. Pengfei Han. He is an assistant professor of finance at the Guanghua School of Management at the Peking University. He received his PhD degree in economics from the University of Pennsylvania. His research focuses on innovation, entrepreneurship, and economic growth. Pengfei, I will now turn the program over to you.
Thanks, Zhigo. Well, it is my great pleasure to be the moderator of this lecture. Today, we are very delighted to have Professor Lars Peter Hansen from the University of Chicago. Professor Hansen is David Rockefeller Distinguished Service Professor in Economics and Statistics at the University of Chicago. Professor Hansen is a deep thinker. In particular, he contributed many insights into the study of decision-making and their uncertainties. His research connects three branches of economic studies: macroeconomics, finance, and statistics. Well, if you study economics, I suppose everybody knows about his paper about generalized method of moments. It has been cited for more than 14,000 times. Because of all these contributions, Professor Hansen was awarded the Nobel Prize in Economics in 2013. For the Chinese audience, Professor Hansen is a good friend of China. As the director of Macrofinance Research Program of the Becker-Friedman Institute, he co-sponsored the conference, The Macroeconomy and Finance in China. And so he was in Beijing just in December last year. This year, international travel is probably too difficult, but still, we are very happy that Professor Hansen can give a talk online. As the leading expert for studying uncertainty, he will share his thoughts about how climate change uncertainty affects social valuation and public policies. So during the presentation, please keep yourself muted. And if you have any questions, please post your questions in the chat box together with your affiliation. I will collect the questions, and we're going to have some 10 minutes for Q&A at the end of the lecture. Okay, with that being said, Professor Hansen, the floor is yours now. The presentation time is about 45 minutes, and we look forward to your talk. Thanks.
Thank you very much. I really appreciate this opportunity. Thank you for the kind introduction and for this opportunity to share some insights on a problem, on type of problems that I have been thinking about quite a bit over the last few years, and I really think are of central importance. So I want to be talking about uncertainty and its contributions to how we should think about prudent policymaking. And it's so what's going to come into what's going to come into play is how this is going to impact so-called social valuation. So in finance, we're all the time talking about market valuation. Well, those same type of tools are also useful to thinking about social valuation. And I'll say a little bit more of that as the talk proceeds. And that of course, then spills over to policy as well. The particular type of applications I'm talking about today is based on some joint work that I've done with Mike Barnett, who's at ASU, and Buzz Brock, who's at Wisconsin. So what is the challenge here? So there's a human impact on the environment that is not internalized by markets. So this is a case where social costs and private costs are different. Market prices, absent taxation, will not track the correct social cost. This is the so-called externality. Now, what makes this challenging is that is the uncertainty that's attached to it. It's nice, it's handy to break that uncertainty down into two different sources. One comes from the geosciences. CO2 emissions today have an impact on the future climate. So it's a problem that's studied extensively in the geosciences, and we want to draw on some of their evidence in order to do the type of calculations that interest me. Economics comes into play because climate change in the future is going to alter economic opportunities and therefore social well-being. Again, there's uncertainty attached to this as well. These two different sources of uncertainty, it turns out to be, they're not like so-called additive. They can be mutually reinforcing. They can magnify each other, and so they can. I think it's important to actually study them simultaneously. Now, what we're aiming for here is this is a quantitative question. How big is this so-called externality, and so how much of a policy intervention does it require? So we're out to try to build a kind of a computationally tractable laboratory that allows us to explore these components of uncertainty. And I'm going to talk about uncertainty in broad terms. It's going to include things like the models we write down aren't quite right, they're misspecified, or there'll be multiple models we'll see that will come into play. And so I want to be thinking about uncertainty in the broadest possible terms here. And then what we want to do is take this and this uncertainty and want to assess its impact on climate policy outcomes. We want to also go into the models and figure out what forms of uncertainty really matter for the outcomes we care about. So, some pieces of the uncertainty may not matter much for the conclusions we care about, and others might matter a lot. And we want to be able to have methods that isolate the ones that really matter. And then finally, we want to explore policy relevant consequences of models in an open and honest way. So I think of this as a so-called quantitative storytelling with multiple stories, where different models themselves allow us to tell quantitative stories. But there's multiple models on the table, each with its different own story. Now, this last one about explore policy consequences in open and honest ways. Unfortunately, the way that politics in the United States works, and I suspect in many other countries as well, is too often it's the person who asserts himself with the greatest confidence that then is able to impact policy. And what that does is it leads to a distortion where uncertainties are kind of stuck in the background, and people project themselves with far more confidence and certainty than is really justified by the scientific evidence. We want to work against that and actually talk about ways we can incorporate the scientific evidence and the limits to our knowledge in ways that can still give rise to prudent policymaking. So what does asset pricing add to all this? So what does asset pricing do? Well, it tells us, when I teach in investment classes, it allows us to answer the question, how do markets assess investment opportunities in the face of uncertain future net payoffs? So macroeconomics, in contrast to a lot of macroeconomics, is really kind of sticks uncertainty on the foreground, and it's spent decades kind of producing tools that help to think about it. We want to draw on those tools and extend them in where appropriate. But in the typical type of investment class are these assets. Now, for me, assets I want to interpret broadly. It can be financial, physical, human, organizational, or say environmental forms of capital. Associated with each asset is a prospective sequence of net payoffs to investments. And so what asset pricing is all about is figuring out how to map those prospective sequence of payoffs into current period values. Now, what I want to be doing is applying these tools to social instead of market valuation. So, so in these settings where we think that there's this wedge between market valuation and social valuation, I want to pass through, I just want to give you the same set of tools to help me understand that wedge. Okay, I'm going to be using the so-called social cost of carbon. Now, the social cost of carbon has been actually used in a various different policy frameworks. Unfortunately, it's not always well defined, and its meaning and measurements can have differed across applications. In this work, we're going to use a well-posed version of it, and we're going to use this as an analytical tool to assess the impact of uncertainty. So how does this work? Well, as I talked about, there's an externality. Carbon emissions alter the climate, which in turn impacts economic opportunities and social well-being in the future. That is not captured by typical market prices. The social cost of carbon includes the socially efficient so-called Pengfei taxation on carbon emissions that corrects this externality. So where's this wedge? The social cost of carbon in comparison to market prices then kind of tells us how big that wedge is. And then once we understand how big that wedge is, it tells us what the scope is for policy to try to close it. So where does uncertainty emerge? So I've already made reference to this notion of quantitative storytelling. Models allow us to tell interesting stories. The models aren't exactly right. There's a bunch of simplifications, but they provide us insights. And here we're interested in quantitative insights. And then multiple models are out there. So formally, I want to distinguish between three different components of uncertainty. And these type of distinctions, at least heuristically, go back, many decades back to Frank Knight's work on uncertainty, arguably does some of Keynes's early work as well. But neither of those early sources really did a very good job of mapping in any type of formalism, which we have to do here. So the components of uncertainty that I'm going to be talking about are risk, okay? And I think about this uncertainty within models. So when we write down models, we put these specific random impulses, so-called shocks in those models. We assign distributions to them. That allows us to deduce probabilities over future events. So risk has to do with things about unknown outcomes, but known probabilities. Where does ambiguity come into play? Well, I have multiple models. Each model gives rise to a different story with a different implication. How do I weight those different stories? How do I, and which ones do I pay more attention to? The third one, and this is part, the second component is what a lot of statistics has been wrestling with for decades now. The third one might be the trickiest one. It might be the most important one. The models we write down, they're wrong. They're simplifications. They're insightful, but they're not right in some literal sense. Each model is an abstraction, is not intended to be a complete description of reality. How then does that potential misspecification, alter what we care about quantitatively? How do we assess that? So the calculations I do today, I'm going to be featuring the ambiguity piece of this, although in other work I've explored the misspecification consequences as well, and it's very possible to combine the two. So let me just kind of talk through how you navigate uncertainty in this type of circumstance, and then I'll try to add a little bit more detail. So as I said, the probability models we use are misspecified, and there's a bunch of them. What the aim of this is we want to be able to use the models in sensible ways, not toss them out. We don't want to reach a conclusion, well, the model some simplification, but so therefore it's no good. But we want to use it sensibly. We want to use the tools of probability and statistics to limit or bound the types of uncertainties that is entertained. Now, economics and economic classes often focus on risk aversion. Finance classes often talk about risk premium and risk prices. This aversion is kind of, which I talk about, this ambiguity aversion or uncertainty aversion, this dislike of uncertainty, like risk aversion, can lead to certain type of cautious adjustments here. And so we do, so uncertainty version will come into play in a central way. Now, once you lay all this out there, what's the implementation? Well, you want to take your model, do it multiple models. You want to then start playing around with what pieces, what subjective inputs really matter. Which ones can you move a little bit and get big consequences to the outcome? And so someone composes formally, which you're computing, making the computer help you locate the most adverse consequences for the decision maker. So it becomes a way to do a type of structured sensitivity analysis, if you like. So there's decision theory. I'm not going to really get into it here. I'm going to, in fact, let me be very clear that I'm going to be very poor in terms of giving references to related research just because of time constraints. The real way, whether we're going to be using this decision theory, though, is to kind of take a very high dimensional component of uncertainty and collapse it down into a very low dimensional representation based on what's consequential for the decision maker. The formal approach. So formally, think about, for a single decision maker, think about changing that decision problem to a so-called two-player game. One player is going to go through and look across the subjective input. One player might announce a potential decision. The other player is going to go in and look through potential ways of that there might be sensitivity to the subjective inputs, figure out which ones really matter by solving a minimization problem. And then the other agent's going to be figuring out how to optimize subject to this uncertainty adjustment with the minimization. So we introduce a second player who's engaged in doing the sensitivity analysis, whereas the initial player, the fictitious planner, is engaged in maximizing social well-being. Now, I'm going to be using a construct, I'm not going to really get into the details here, called relative entropy to bound probabilistic uncertainty. This is a mathematically convenient set of, it's a tool, it's been used in a variety of literatures. Now, some of the calculations are going to involve doing things like solving numerically PDEs, which with some extra twist in the computations. So that's kind of how this plays out in the background. This is what, in terms of computer coding and the like. So how does valuation come into play? I've described this kind of two-player game going on here, the minimization, maximization. The minimizing person here is actually minimizing over potential probabilities, exploring the subjective components to uncertainty. So what's going to come out of that is kind of a so-called worst-case probability. This is going to be a worst-case subject to very bounds, and these bounds can be very stringent. So people often complain about worst-case analysis is just bad because you can get arbitrarily bad things happen. But you have to bound things here, and that bounding is really important. But kind of once you deduce this corresponding worst-case probability, that's what you want to use for making uncertainty adjustments in terms of valuation. And so there's a tool in finance called the risk-neutral probabilities, in which we start off with the objective probabilities. We make risk adjustments by doing risk-neutral probabilities. There's a counterpart that goes on here, and this two-player game helps us figure out how to make those probability adjustments, and those additional probability adjustments adjust for this broader notion of uncertainty. So in terms of the kind of formalism coming from asset pricing, that's the key thing. So let me just kind of lay out a little bit of notation here. I don't want to get too lost in the mathematics here because of time constraints and the like. But suppose I'm working in continuous time. Suppose I have a state vector process, which evolves like as a so-called Markov diffusion. It's got Brownian increments attached to things that serve the role of shocks. And then there's this theta parameters that are going to index alternative models. A is going to be a so-called decision process here. X will be the state vector process. Now, we want to use dynamic programming type methods, and we know that boils down to doing things like computing value functions. And so think of there being continuation values here. And so a value function is going to have a local evolution attached to it. And this, this is part of how the optimization works. You have to figure out that local evolution. And here you use so-called Ito's lemma to figure out what that is. If B is the value function, this is the usual Ito formula, where you've figured out what the local evolution, the local so-called drift is by taking the first derivative of the value function, multiply that with the so-called drift vector, and then you have this adjustment for the second derivative interacts with the uncertainty piece here. Now, we can now, this type of decision problem then we know turns into a PDE and Hamilton-Jacobi-Bellman equations and the like. That's kind of very, very, very well known. What's different here now so far is this theta is going to index alternative models. How do we proceed when theta is not known? So imagine that I've got a so-called baseline posterior distribution over theta. So I come into date t in my with some probability model, and then my best I solve so-called prediction or filtering problems that come up with this distribution q sub t as of date t. Okay. Then one possibility is we just use that qt and we just average out the that kind of drift uncertainty using that qt measure. But that presumes a lot of structure and a lot of subjective inputs at the outset over which we can have uncertainty. So what I'm going to do is I'm actually replace that by, instead of just forming a simple average, by this x log formula here. And this is this cautious adjustment to the so-called drift of the continuation value. And that's of interest. Its origins come from solving a minimization problem where we're looking over changes in that Q distribution. That's what this G is doing. It's looking at potentially changing that Q distribution, but we don't want to change it arbitrarily. We want to put limits on it. Okay, and that's where the C sub A parameters is kind of a penalty parameter for imposing for the search over alternative ways to twist the original QT. Now we want a cautious adjustment, and that's why we're doing the minimization. So the solution to that minimization problem produces a tilting that has you tilt towards the drifts that are most adverse to the decision maker. And that's all that's given by this exponential tilting formula at the bottom slide here. It says I'm going to I'm going to kind of reweight the probabilities according to what the decision maker cares about, and that's where the value function comes into play, and it's in a so-called drift here. Plug that in, and then you get the top formula there. Okay, so this is just a way that we can go through and kind of do sensitivity over what happens if we change the subjective inputs. Maybe we have an initial set of models, we don't really know what weights to put over them. We might make them equally weighted, but suppose we jiggle those weights a little bit, is that going to matter? Okay, so the social cost of carbon as an asset price. So we all know about impulse response functions for macroeconomics and the like. So there's a type of impulse responses in the background here. Imagine that you put a pulse of emissions into the environment. That's going to affect carbon concentration in the atmosphere over current and future time periods, and spill over into changes in temperature over current and future time periods. That's where I get kind of geosciences, and to the extent the model is nonlinear, then these can be so-called nonlinear impulse responses. Then, of course, we need to incorporate margin utility adjustments as we typically do in asset valuation. We need to depict also the interacting uncertainty between economic damages, that is, once we change the environment, how is it going to affect economic opportunity? Uncertainties show up there because of how decision makers might adapt to the changing environment and the like, stuff that we don't have full knowledge on. But we also don't know about this fully. We don't have a full, precise information about how emissions today affect temperature in the future. So So we need to think about these two uncertainties, and they interact in important ways. And just like an asset pricing, we want to do so-called stochastic discounting, but here's we want to use this uncertainty-adjusted probabilities that I talked about before. So what the social cost of carbon is going to do then is kind of agglomerate. This is social cash flow about going from what impact emissions today have on marginal utilities in all future time periods, and then we have to so-called discount that and then adjust it for uncertainty. That's how this social cost of carbon becomes an asset price. So I'm going to put this inside of I'm going to be working with a fairly straightforward macroeconomic model, and then I'm going to put in some climate change consequences into it. So look, I'm going to describe it pictorially. I've got slides that give all the the equations, but let's given time constraints, let's see how much we can do with the picture. So capital is going to be productive. This is going to be a so-called AK model with adjustment costs. Capital is productive. It gives out output. That output can be divided and split apart into investment. It can invest in future capital, help grow the economy. It can be drawn out into current consumption, affecting current economic well-being. And in our richer set of models, we also introduce exploration. What you might do is you might use some of the resources to engage in the discovery of new reserves. And now out of that stock of reserves, then we're going to draw down emissions, and then there's emission, and to the extent we like to drive cars and therefore consume fossil fuels, then that then enhances our economic well-being. So far, there's no climate change in this thing. This model, the way that we've set it up, has a so-called balanced growth path to it, and then one can compute out that it's a fairly standard macro-looking model with two capital stocks because the stock of reserves basically functions as a second capital stock. Okay, but now, oops, sorry, I hit the wrong button. How about that button? There we go. That's better. Now we want to put in the fact that emissions not only we like to drive our cars, yet they also affect the climate adversely. As we affect the climate, that's going to then damage or limit the productive capacities of the economy, or to diminish the economic well-being. This is the part, that red part is where the so-called externality comes into play. So when we build our macro model, we've got all these different ingredients, and then what's new to this is this mapping from emissions through the climate into damages. The rest of it's a fairly standard macro model with the addition of this exploration for reserves. So there's some equations here. But given time constraints, I've kind of talked you through what goes on with these. So I'm going to skip through them. Now, there's two different ways that the people have suggested exploring the impacts of climate change. One is the adverse impact on production possibilities. In fact, the calculation it's going to do today is going to be of that type. The other one is the adverse impact on growth potential. Now, in fact, we know very little about the second one, and it's a very tough one to measure. So I'm going to focus my computations on the first one. I do think the second channel is potentially interesting too, but the uncertainties there are even more substantial. Okay, now I'm going to follow the economic literature by having kind of a static adjustment for damages. This is not going to do justice to things like adaptation and the like, and so there's very important to think about ways to extend this. But I'm going to follow what Nordhaus and Weitzman and others have with these so-called damage functions. I'm going to make the damage function here. So there's going to be a damage process NT, and it's going to capture these negative externalities to society. It's going to have this form that's going to be kind of piecewise quadratic. It's going to have this quadratic regime in terms of, say, temperature relative to pre-industrial, and then beyond some threshold, I'm going to just I'm going to kick up the curvature. Okay? And then what's going to be unknown the uncertainty is going to be over this kind of lambda 2 plus parameter that allows, that says where things could become much more curved based on that. And so I think it's probably easiest to think about this pictorially. So let me jump to this picture. So we're going to imagine that this changes relative to pre-industrial. Some people coming out of the geosciences say that we should just simply impose a 2 temperature degree increment and as the upper bound, and beyond that, then we should not allow anything. That's like having a damage function with this vertical line attached to it. In most economic analyses, they allow for smoother trade-offs. So roughly speaking, this red line, it shows you the diminishment in the productive capacity as a function of temperature. The red line tracks the type of numbers which Nordhaus uses. Weitzman would argue that those were way understate the potential damages. And why there's a debate about this is we're talking about differences that we haven't yet observed and speculating about how big they might be. So it's hard to get much evidence in order to help sort this out between this, which of these 2 lines are the same. They're tracking each other identically up until 2, and then they diverge. So this is a case where you just can't look at evidence and it's going to magically reveal the answer. So now I want to talk about the simplified climate dynamics. As I've said before, this is one of the pieces that typically in a lot of in both the simplified geoscience models as well as some of the economic literature, the climate dynamics are broken down into 2 parts. Emissions-induced changes in the future carbon concentration in the atmosphere. So you might omit carbon. It's going to immediately go in the atmosphere, but then some of it's going to be pulled back. It's going to be absorbed by carbon sinks, vegetation, and the like. Okay. Now, carbon concentration in the atmosphere is going to alter temperature, and that's going to also play out in the future. That's going to play out over time. So what I'm going to show you is some characterizations that involve both of these pieces together. They just piece the 2 together. And these are so-called convolutions of these 2 different effects. And I'm going to draw from pulse experiments for alternative climate models. So just a little bit of background here. The type of climate models out there are very complicated models numerically. We can't put those models inside an economic model and have anything that's even remotely tractable here. So what we have to do is kind of take these heterogeneous predictions off these models and collapse them down into something that's then interesting and useful. And that's where these pulse experiments are come into play. They're going to be a counterpart to impulse response functions that economists think about, but the impulse here is an emissions impulse. So what I'm going to do is I'm going to show you the model differences for these so-called pulses. So these are temperature responses to emissions. Okay? We're going to compute these for a 100 gigaton pulse for 153 different models. Okay? So we've got 153 different models on the table, and we're going to crank these out. We're going to crank out these. They're the implied impulse responses from those models. Now, I'm not going to show you 153 curves, so it would just look ugly. So what I'm going to do is I'm going to give you these so-called quantiles or percentiles. Take the green line here, the green dot dash line. 10% of the models have responses that go below that line. 90% are above it. Now take the purple line. Okay, now 33% are below and 67 above. The blue line, 67 are below and 33 above, and the red line, 90 are above, 90 are below and 10 are above. This is just a way to show you how much divergence across models there are in terms of how the impact of temperature, the impact of emissions changes today on temperature in the future. You can see there's a rather substantial degree of uncertainty showing up here. So what we really care about for this in the social cost of carbon is an effect can be collapsed down into approximately a single number, kind of the discounted the discounted average of this curve. Okay, and in the simple enough settings that becomes an exact thing to look at, but then more generally, just an approximate thing to look at. So imagine that we take a subjective rate of discount. We're going to compute the discounted versions of these curves and convert it into an average, so an exponentially weighted average. Now I'm going to translate all these different curves into, so I'm going to map each curve into a number, and then I'm going to tell you the histogram of numbers across all the models. And that's this. Again, this is just showing you the spread across that comes out of these 153 different models. So this is a histogram of the 153 models. So you can see that maybe the median here is around 1.72 or so, but there's a lot of the numbers can go as low as say 1.2 with non-trivial probability, and up as high as 2 or even 2.5 with non-trivial probability. So there's a fair bit of spread here, okay, across this. So this is the part. Think of this histogram as telling us the uncertainty coming from the climate side. Think of that damage plot I gave you as the high and low damages, giving you some indication of the type of uncertainty coming from the economic side. And then we put the two things together. Now we're going to be engaged in kind of a, it's useful to produce a kind of uncertainty decomposition here. So I talked about that probability adjustment we're going to make for broad notions of uncertainty having to do with model misspecification or model ambiguity. Okay. So what I'm going to do is I'm going to take the solution to one of our so-called fictitious planner problems, and I'm going to compute things by just using the unadjusted probabilities versus the adjusted probabilities. I'm going to compute the so-called social cost of carbon. These are these kind of discounted present values, and then compare them. That's the uncertainty adjustment. So here's what we get coming out of that. The total social cost of carbon here. This is off of, we're solving a fictitious planners problem here. So what we're doing is we're actually figuring out the socially optimal amount of emissions, taking into account uncertainty. We're then looking at this social price of emissions. Now, as you get closer and closer to damaging the environment, that's going to increase on you, and it's going to increase in accordance with that purple line there. Now, to get a handle on how important uncertainty is, I'm going to go through and do the same calculation, but I'm not going to have that uncertainty adjusted measure. Then what you get is this, and then once you make that comparison, you can show it's that the amount of that total that's coming from an uncertainty adjustment is given by the shaded in purple area. So at least in this calculation, this is quite substantial. So basically, it can be quite substantial here. So let me now do things a little bit differently. What I'm going to do is I'm going to run a case in which the planner is ambiguity averse, and I compare it to one in which he could say he's ambiguity neutral. Maybe he doesn't know probabilities, but he doesn't care. I mean, he's just going to average instead. He's not going to make any adjustments. So we're beginning with a baseline probabilities over models that says that all models are equally equally plausible. And then I say, well, that's just, why should I take that seriously? And then we're going to start tilting that a little bit, twisting that a little bit, changing that distribution. So I'm going to start moving that histogram and see what happens. That's kind of the sensitivity analysis here. So with the ambiguity aversion, then you choose wisely then to reduce your amount of emissions here. So they go from the red line to the blue line. So once you activate the sensitivity over the subjective inputs, you induce a form of caution, and that shows up in the reduction of emissions. Here's a comparison to the social cost of carbon now. This is different than that uncertainty comparison. So I've got ambiguity neutral versus ambiguity averse. And the important difference now is under ambiguity averse, it's a different emission scenario than under ambiguity neutral. And so these two curves start looking closer together, in part because they're tracking different emissions paths. You're consuming a lot more fossil fuels under the neutral case than the ambiguity averse case. Whereas that previous uncertainty calculation held the trajectory of emissions the same. And so these are just the type of calculations one can do. Now, what's behind all this? Okay. Well, what's behind all this is this tilting of the distribution. So think of the blue one is just reproducing the histogram. I understand there's a kind of a flawed choice of colors here, since blue, since before it was red. But think of blue as the baseline set of histogram. What you're doing is after 50 years, instead of using that histogram, you're implicitly using this one instead. And so you've done this, I would argue, small tilting of the distribution, where you've shifted a little bit more weight to ones that have higher climate sensitivity. Those discounted impulse responses now are, the bigger ones are weighted a little bit more. And then you can see that by the fact that the red bars on the right are higher than the blue bars, and then on the left they're lower. These have to be probability. These have to add up to probabilities. So what you do is you shift from the low ones towards the high ones, because the high climate sensitivity, which causes the planner the most concern. Now, what happens after 75 years, it becomes somewhat more substantial. We're moving closer and closer into the region in which you're doing serious damages to the economy. And then after 100 years, it becomes much more substantial. As we see now, we're loading considerably more probability up on the upper tail here. And so trying to assess about how averse a decision maker should be is to some extent saying, how much are you, do these changes in probabilities look, how sensible do they look to you? Does it seem like you're doing really big injustice to the evidence, or do these seem to, or given we don't know how to rate the models to begin with, maybe this is a perfectly reasonable thing to be doing. And then one can adjust the ambiguity aversion parameter to make these changes bigger or smaller. Okay, so this just shows you the type of calculations which we can produce out of this. So the model I wrote down has some limitations in it. It's only got a single, only got a single capital, productive capital stock. We might have reserves, but what's off the table is kind of a green versus a clean versus a dirty production. And so one can easily imagine having a clean technology and a dirty technology, and trying to understand whether we ought to be subsidizing the clean technology or not. Nature-based solutions, we've kind of put them on the back burner, but maybe it makes sense to engage in policies that help to increase sink capacity or kind of enhance resilience or biodiversity and the like. What can we do to encourage productive and digest economic responses to climate change? So putting on the table richer economic models will then put these type of important questions on the table. So we view this as a very important way to push this agenda. Of course, we have to make this computationally tractable. But the point I want to make today is that each of these extensions will open up new channels with uncertain consequences. They're not going to, there's no reason to believe they're going to make uncertainty less consequential. They're going to allow us to investigate how alternative policies will close the gap between actual prices and idealized notions of the social cost of carbon. So with that, I think I'm going to would like to close with a couple of quotes from people you might recognize. First one is Confucius. Hopefully my translation is pretty good. It was not done by me, of course. To know what it is that you know, and to know what it is that you do not know, that is wisdom. So this gets to the notion that there's limits to our knowledge, and there's gains to acknowledging those limits. Another American author / philosopher puts this a little bit different way. Education is a path from cocky ignorance to miserable uncertainty. So what I hope in today's talk is that, yes, I put uncertainty on broader notions of uncertainty on the table than are usually in most conversations, There are ways to address it, however, and hopefully that can help you deal with what Mark Twain calls miserable uncertainty. And with that, I would like to close my talk and open things up to questions.
Okay, thank you, Professor. And this is perfect timing. And thank you for sharing your thoughts about this intriguing model about the social cost of carbon. And also, it's very thoughtful of you to cite both Confucius and Mark Twain to conclude your lecture. And to begin with, let's consider a question about renewable energy.
Yes.
So the supply of crude oil producers is highly geographically concentrated in just several, the so-called petrostates. And the supply of renewable energy producers can be more geographically dispersed. And would that help to resolve some of the supply shocks of these petrostates that we observed in the fossil fuel age? I mean, because the supply is more geographically dispersed, is it going to reduce the possibility of energy crisis? And is it going to reduce the fluctuation of the macroeconomy? And how do you think about that implications?
So something which my collaborators and I have talked about, in fact, Buzz Brock himself has done research on, is this model is way too stylized by having kind of a world economy, so to speak. And there's no doubt that things like climate change affect different regions differently, different economies differently, and having some type of spatial or geographical heterogeneity or diversity or heterogeneity at the same time seems very important for the design of prudent policies, because climate change is going to affect these different economies differently. So that's only a direction which we want to go, and we think it's a very important one for thinking through policy challenges. Now, what the question noted is the fact that, well, maybe the existing stock of resources are more concentrated in some places than others. It seems to me like to the extent you start subsidizing technologies that are more easily accessible across a wider spectrum of locations, then that's going to affect the wealth distribution across the different economies, or it's going to affect their social well-being. And that type of distributional effect may also be something which people find desirable. And so at the same time, we're trying to build we hope to build models with some type of geographical component or heterogeneous economy component. It will at least open the door to asking questions like that as well, and looking at the heterogeneous responses to different policies. So, like, good question. I think to address it, our models, you have to go beyond a model of the world economy and to have multiple, and explicitly put on the table multiple regions.
Thanks. So let's consider the second question. It's a question about China. Yeah. And so China plays a big role in the supply chain of many type of renewable energies like wind power or solar panels. For example, China accounts for some 70% of the world's production for solar panels, some 70% of lithium-ion batteries, and some 45% of wind turbines. And so there are some discussions that China may become the next electro state and in the new age of renewable energy. And how do you assess that possibility? And if that's indeed going to happen, and what do you think of the implications on the new world order during this new renewable energy age?
So I guess these two questions are related. In the background here is, what is the global policy going to be about taxing or restricting or limiting carbon emissions? Doing coordinated policies across countries is of course very challenging. It does seem to me like, to the extent we were to do things like impose a carbon tax, which I have some sympathy with, absolutely, that's going to then make all alternative energy sources more economically viable. And that then will, of course, have implications for resource allocation across the entire world. which economies have the biggest advantage there, I'm not sure I know enough to have a very sharp speculation about that, but I think that would very much be a possible outcome. I think in the short run, the concern is how do we get to the point? I mean, what's the way, how do we want to deal with the fossil fuel consumption now? It's not yet, it's still a viable technology now. And maybe over time, alternatives will become cheaper and cheaper and make fossil fuels less and less economically viable. But I suspect at some point in time, we're going to have to continue to think. I sort of have to continue to think about policies that limit it, that should limit its fossil fuel consumption in ways that encourage, that open up incentives to engage in other type of investments. So to the extent you tax fossil fuel consumption, then indeed it's going to make green technologies more attractive and the like. So I think those type of policy effects can be quite an important contributor to this. So I guess my main interest is how do we design the prudent policies to kind of push us into a path under which we're doing much less damage to the climate. And then of course down the road that will renewable energy will no doubt play an important role.
I see, thanks. So next, let's consider a question from Eric Zhang. So his question is, one of our tasks is to continuously reduce the uncertainty in climate prediction. So what are the typical applications of big data analysis methods in climate change prediction and policy formulation?
Yeah, good question about big data. So big data, one of the kind of course, I and everybody are fans of big data. It's fascinating to watch things like machine learning type techniques for analyzing and finding patterns and the like. But the data richness often tells you only part of the story. The data is only rich in some places, and it's going to be necessary to extrapolate it into others. So there's been crude stabs at trying to say to try to assess damage functions, looking cross-sectionally in order to figure out what's going to happen over time for a given economy. But to what extent do you want the U.S. economy now, once it's warmer, to start looking like the economies closer to the equator? And I think there's much more going on there than just issues of temperature. And so it becomes quite challenging to kind of go from cross-sectional evidence to figure out what's going to go off of the dynamics. And in that damage plot I showed you, a lot of the speculation now is about what happens when we move the whole world into places that we haven't, temperature changes which we really haven't observed. So yes, we can look cross-sectionally to get some type of information about it, but it's still going to require models, structural, formal models in order to extrapolate the evidence from a place where we have data richness to a place where we have data sparsity. So it's certainly a case where we can't just let the data speak and out's going to pop the answer we want. Yes, you want to use as much data as possible, but and kind of put it to good use, but it's not going to magically solve all these. It's not going to magically resolve these uncertainties. If you look at the uncertainties associated with this kind of mapping from emissions to temperature, there's been kind of Bayesian estimations of this as well. I remember reading one study a few years back was pushed to it by other researchers, and the key parameter, the key climate sensitivity parameter, basically the Bayesian posterior tracked the Bayesian prior, which means the data was just not being very informative. So to the type of questions we're looking at from the geoscientific side, it's also the case that we're not really learning quickly about these transmission mechanisms. Now, once we start damaging the environment even more, then that might enhance our learning. But by that point in time, it may be very, very costly to act, and it might be much more prudent to act now. So it's possible the learning along that dimension could become much more substantial in the future, but that's probably going to also occur in situations where we're already doing much more major damages to the environment. So yes, we want to use big data, but you got to use it with models, and we've got to build it. We've got to be looking at these dynamic models. We can't just turn this loose on empiricists and expect them to give us the answers.
Thanks, Professor. So next, let's consider a question from Bin Dong, and he's asking a question about ESG. The question is, ESG is becoming a standard index for both retail and institutional investors. So what is your opinion about the performance of sustainability investment in short and long term?
Yeah. So it's my impression, and in fact, the scholars I know that have studied this, in order for them to really get credible models of this type of phenomenon, they have to put into investor preferences a specific preference for liking to invest in clean technologies, and then without that, I think it's harder. It's hard to justify this as being a truly wise type of portfolio strategy to follow. And I think a lot of what's going on now is heavily having a lot to do with rather heavy marketing. Now down the road that can change as we find these green technologies become more and more economically viable because of policy interventions, and then that whole story could change. Now I have no problems with investors that say, I want to invest in green technologies because that's what I care about. But if we really want to design a policy to, I don't think we want to rely on all investors taking that perspective. And what I'd rather do is be thinking about, instead of doing the policy lever through this type of potentially distorted investment policies, to do it through things like taxation policies, like the social cost, like Pengfei taxation, Pengfei taxes, and then those in turn will make these type of alternative investments more and more productive and attractive. But I don't object to people that I have no problems with people saying that I want to invest. These are investments I want to do because it makes me feel better if I make these type of investments. I mean, that's a statement of personal preferences. But if you're a portfolio manager trying to manage things for for pensions and the like, I just don't think that's a very prudent way to go. I think you want to invest. You want to look at the investment opportunities in terms of what's in the best interest of the people who need the pensions down the road. So it depends a lot on the clientele of the portfolio manager as well.
Okay, thanks, Professor. This is perfect timing. We have less than 1 minute left. Zhiguo, do you want to conclude, or do you want to add one more question for Professor Hansen?
Lars,
yes.
Thanks a lot for your interesting and very insightful talk. I do have one question for someone like me who sort of understand that this is so important, and also that I echo the question right before that I came on, I took it over, is about this ESG, all these things. So policy intervention, clearly that we need it. And what in your mind, in the history in the US, that you think is the most successful policy intervention on this issue, so that maybe China can learn something from it?
Well, I don't think.
Or you might think that it's not as good either.
I think the U.S. has very little to brag about on this topic, so I can't say that we haven't had a whole lot of successes. I do think engaging in things like carbon taxations are potentially productive, but kind of look what. But you have to. The thing that's tricky about those is their distributional consequences. If to the extent those taxes fall on us much more heavily on a subset of the population and maybe the less wealthy, you have to figure out ways to compensate them for it, which then makes them tricky. I mean, look at all the protests in France once they started talking about raising gasoline taxes and the like, and that led to a big pushback. So the tricky part of that is figuring out the redistributional aspects of it. What will you do with the tax revenues, and to what extent can you remit them back to the people that are being their livelihoods are much more sensitive to say fossil fuels. So I don't think the U.S. has a lot to brag about here. I do think, in principle, though, that well-conceived things like cap and trade policies or carbon taxation policies can be quite productive, and I certainly definitely support those. I wish the U.S. were a leader in terms of climate change, which has certainly not been.
No, we are going to have one.
Yeah, well, maybe we'll see. We'll see what comes
We'll
out.
see.
I also think that, at least I used to think, and maybe this is less true now, I used to think that the situation in China and the situation in the US was a little bit different, because air pollution has been a big issue in China. So, part of the fossil fuel consumption has to do with what you're going to do on air pollution, which has done direct health impacts. And so, which is less of an issue in the US, which makes it a little bit different perspective on the policy there as well. But I just honestly I can't say the U.S. has been very prudent at all on this in this area, and hopefully in the future the U.S. and other economies can improve on this.
Yeah, in a way, the reason I ask is perhaps it just feel like the U.S. is using some market-based intervention, while China it's like seeing big problems and then they're just using big hands to make things right for a while, and seems like we are on the, China is on the right road now, and maybe we would like to think about more about a market.
So I certainly think, I mean, this is the market-based approach is kind of underlies my interest in cap and trade and carbon taxation and the like.
Exactly.
And the one danger in just putting direct government subsidies to green technologies is that you can easily lead into investment into the wrong ones that aren't very productive, just because for political reasons you end up subsidizing, you're making very poor decisions making in terms of the allocation, which means it might be much better to do things like implement taxation and then let the market figure out how to reallocate towards the cleaner technologies as you make the as you make it more and more costly to consume fossil fuels. So in principle, I like that option. I think what we'd like to do in the future is do comparisons between the impacts of carbon taxation versus subsidies to green technologies.